So we have Andrew Lanoie here today. He's the founder of Four Peaks Capital. So he does manufactured and affordable housing investment, and he's going to share his experience with us on that and what his company does. So prior to that, he was a talent agent at William Morris for 16 years, representing some of the world's biggest celebrities. And he's also the host of the Impatient Investor podcast. I'm really happy to have you, Andrew, here today. So with that, I'm going to pass on to you, and we can start. Thanks.
Perfect. Yeah, thanks for having me. Really appreciate everyone taking the time to tune in today. Can everyone see the screen okay?
Yes.
Great.
Yeah.
So I'll just give a quick background. I'm in Phoenix, Arizona now, where we're headquartered out of. I was in Los Angeles for 20 years and worked in entertainment representing celebrities. When the subprime crash happened, I started to buy single family houses about 2009 in Dallas, Texas, which was a great time to get into that market. Bought a lot of houses with friends and partners and went on to buy some in Memphis and Atlanta, and built a little turnkey company there with some partners who moved there. And we were buying C-class single families. And most of what we did were buy and hold, but we did some flips in that market. About 2013, I stopped buying single families because things just stopped penciling out. It just from a cash flow standpoint or model, the deals didn't make that much sense anymore. And at that point, I had a friend who'd been buying mobile home parks in the Midwest, and we took a really good look at that model. And so we started to put the companies together and started to buy mobile home parks. I think our first acquisitions were late 2014 or early 2015, somewhere in that window. My partner, Mike, he and his wife started to buy mobile home parks in about 2007. So they've been doing this for quite a while as well. And that's our sole focus now. Is we own about 2,500 units. It's about 35 communities in 12 states. And I'm just going to go through a quick deck that I put together. I haven't shared this with anyone yet, and just really why we love this space and why it's been so resilient in the past, not only in the subprime crash, but also during COVID in 2020. And I think our asset class has had quite a bit of attention in the past few years, and I'll go into that as well. So let's see here. So we all know 2020 was not the best year for a lot of businesses, but we're starting to see some of the data that's actually coming out now. Being a small business owner during 2020 was certainly had lots of challenges, but we wake up thankful every day that we're in the affordable housing business and we don't own office buildings and retail and restaurants and some of the other things that got hit really, really hard. So last numbers I saw, there were 60 million jobless claims from March to September. The March 16th market crash was the second largest one-day decline in history. This is so interesting. In May 2020, only about 32% of retail stores were paying rent. Home sales plunged. The GDP was the worst recorded economic performance in U.S. history in Q2. And across the board, industries were decimated. I have friends that are in the concert and sports business. They lost better part of 100% of their income in 2020, which for some companies was just a massive, massive loss. Car rental companies going bankrupt. I mean, we've seen kind of all the headlines on this. And one of the most interesting things that we haven't seen all of the shakeout from is the millions of commercial and residential mortgages that the banks started to take back. And if you think about how banks work, they're so backlogged right now. I mean, the lenders are struggling to make closing deadlines now that the lending environment's back, but the banks are chewing through. I mean, think about all the restaurants in New York City that were put out of business because they couldn't open up outside. They didn't have the space. I mean, those are all going back to the banks and will get repurposed to something at some point. So, we're just in this unbelievable time right now. And in 26 states, more than 1 in 5 households was behind in rent, and that was in Q3 of 2020. So we all know 2020 was a pretty terrible year for a lot of folks. in our sector, in the mobile home park world, we certainly had some challenges, but overall, we did really well. Our collections, well, before I get into that, let me get into some of the stats here now that we're on the other side of 2020. So this graph right here, this is, there's a couple graphs that we have on this, but this one is specifically from Seeking Alpha. And it shows NOI growth on the left side, and then it's just simply 2000 and 2020. And this line right here, the blue line, is manufactured housing or mobile home parks, and then right below it you can see self-storage. So the housing crisis was here, and you can see a lot of the other segments. You have industrial, multifamily, office, shopping, malls. A lot of those had a dip during that time. And manufactured housing did not. And here we are now during COVID 2020. And same thing, the manufactured housing has been very, very resilient. And this right here is just the REIT index. And again, industrial's right below manufactured housing, but manufactured housing was on top again.
So Andrew, why do you think that is? Like, what is the, like, what does the data, like, what do data studies say as to why manufactured housing is more resistant? If you can
Yeah,
share
let
with our
me.
audience.
Yeah, sure. Let me get into that and save that question, because I think some of that will get answered in this. But we've been very, very bullish on affordable housing, and just as a point of reference, our lot rents at all the communities we own, the median lot rent is $300 a month. So I think I'm going to answer your question, but let me go through some of this to see if this makes sense. So again, in the manufactured housing world, a lot of other industries were decimated, but we overall came out and did fairly well. Collections from our residents, we were at over 90%, depending on the month. We're typically in a normal year, we're in the mid 90s for collections. So once again, this space did really well. Same thing in the subprime crash. What we found is that a lot of our residents were essential workers, and a lot of them were still working. And honestly, below our asset class, there's not really very much room for someone to go. I mean, they're going to be living with family, they're going to be living in their car, or they're homeless. There's not much below the manufactured housing world, just as far as price points. And we'll get into that a little bit. Our new resident applications doubled, and we sold a lot of homes last year. And our occupancy overall was up by 10%. And across our portfolio, we only had about 15 evictions, and a handful of those had started prior to COVID. So, these are all kind of the metrics that we're tracking: collections, new applications, home sales, obviously just overall portfolio occupancy, things like that. So we hear this, right? We hear the rich is getting richer and the poor is getting poorer. And the reality today is that 50% of the wage earners in America are making $31,000 or less. So that's not household, that's an individual wage earner. And that boils down to just under $600 a week. And so you think about someone working at a Target in Moberly, Missouri, making $27,000 a year, and maybe they take home $23,000. It doesn't leave very much for housing allowance, right? So this was so interesting to find. So this is a graph from 1964 through 2010, and it basically shows that this is a long-term view on wages, but it basically shows that wages haven't changed. So we know that the cost of goods are going through the roof. An example I always like to tell is my father's dad, my grandfather, grew up several generations ago and had one salary, was lower middle class. He was had a little plumbing company, owned a house, owned a car, put the kids through school on one salary. And so now in today's dollars, a lot of our residents, mom and dad, each have two jobs. So there could be 4 jobs in one household, and they're barely keeping up with paying the bills, and they're just living paycheck to paycheck. So overall, wages have not increased in really 40 years now. And then we go to just the cost of goods, and we've got everything from movie tickets to fuel, energy, food. And even though this is through March 2014, you can see, some just simply the percentages. So you have wages that have been stagnant, and you have the cost of living basically going through the roof. So that's really what's happening. This is interesting too. The median sales price for a home, and this goes back to 1965. And again, this is a big, this is probably the biggest purchase that someone's going to make, is buying their home. And so this is another cost that has gone just skyrocketed over the years. So why is this driving the mobile home park? And what we're seeing is a huge increase in not only mobile home tenants or residents, but we're also seeing an increase in buyers in our space. And in our model, we want our residents to own their home. So these folks cannot qualify for a Fannie Freddie stick-built loan. They don't have the income, they don't have the FICO. They may not have, they may have a bankruptcy 4 or 5 years ago, but in our world, they can go and they can own their own home. And again, our lot rents are about $300 median across the entire portfolio. And then for about another $300 a month, their resident can own their own home. Yeah, go ahead.
Sorry to interrupt, just one moment. So just to clarify, so you're seeing huge spikes during, like, since 2020 or over a bigger period in mobile home tenants and mobile home buyers? Is it in the current period, like during COVID?
So on the buyer side, probably the last 3 years, and on the tenant side, there's always been a huge demand.
Okay, thanks.
Yeah, but in our data, we had more residents move in last year in the same number of units than comparison to 2019. So, a lot of this, like, the data isn't there on it, but you've got people leaving big expensive areas like California, New York City, and they're moving to other markets. And we've always been in secondary and tertiary markets. So this is pretty interesting too. So this is back on the buyer side. There's something like in around 5 to 10 mobile home parks are being developed every year, a very, very small amount. There's quite a few that get torn down, they're in the path of progress. They get turned into a Amazon fulfillment or apartment complex or whatever it is. So, we're seeing the occupancy rate rise. We're seeing the buyers, and just the volume of the buyers coming in also increasing, and the construction is very, very low overall in this space. So there's only a few in the country that get built, and that's basically, it's almost like the it's not in my backyard syndrome, right? Where cities desperately need affordable housing, but they don't want a manufactured housing or a mobile home park in their own backyard. So that's part of the problem. Let's see here. So prior to 2020, we've been buying now for about 6 years, 6.5 years. Most of the sellers were mom and pops. They were folks that had owned these parks for years and years, and they're getting up there in age, and they want to get out, they want to retire. Maybe they have health issues. We bought a lot of our portfolio over the years from mom and pop sellers. And that's just the natural progress. But what's happened is, and especially over the last 3 years, and Blackstone was one of the first ones to get into the space. They made their first investment last year. It was $550 million. And they've got another investment that they're making, I think, for about the same equity deployment in 2021. So that was a big deal. They haven't been in this space before. So kind of back to answer your question, about 3 years ago, we started to see the big private equity folks in this space starting to show up at the conferences. And a lot of that is because multifamily cap rates were compressing. It was hard to find multifamily. Single families had been hard to find for a while in terms of a cash flow model. And so you naturally start to look at other asset classes. And so our space, probably the last 12 to 18 months, has been, I would say, the hottest it's ever been. Cap rates are the lowest they've ever been. Obviously, we're seeing low interest rates across the board. So a lot of people are really trying to find yield, and that's what's driving a lot of this to our space. So we get asked this a lot is, well, how do you, if you buy value add properties, well, how do you add value and how do you create equity into these mobile home communities? And so the first thing is, it's very simple. We have 3 steps, 3 buckets that we add value in our world. The first is infill, and that's simply we buy a 100-space park. It's 50% occupancy. Maybe there's 20 or 30 homes that are sitting that need to get renovated. We'll send our construction company in. They'll renovate those homes. We'll sell those at maybe $20,000 a home, which is a phenomenal price point. Everything needs to be financed across the board with our residents. No one's coming in and paying $20,000 cash for these homes. They all need to be financed. So that's on the rehab side. And then we bring in new homes. Berkshire Hathaway has 2 companies in the space. One is 21st Mortgage that lends to the residents. They've got about 8 or 9 billion out in loans, and the other is Clayton Homes, and they're the manufacturer. So Warren Buffett's been in the space for whatever that's been now, 12 or 14 years, something like that. And then on bringing in new homes, our price point might be in about the $20,000 range to bring in a brand new home, which again, it's still very, very affordable, but a big difference between a $20,000 home and a $40,000 home. The second way is we could buy a community and the lot rent is $200 and it should be $300. And so when you're raising rents, you want to do that very conservatively over a long period of time. You want to be adding value to that community. You don't want to just come in and ratchet up the rents. That doesn't make sense, and you're going to drive your residents out. So you have to be very mindful that you have to keep your residents happy, and you need to add value to those folks. And the third way is utility bill back. We may buy a mobile home park and the residents are paying very little in utilities and sometimes nothing. They may not be paying a water bill, and we're wondering why the water is so high. And they literally could be running the hose in the yard for a couple of days because they have no concept of a water bill. So that's another thing we do. We pass back utilities, and that's another way where we add top line revenue and increase our NOI at these communities. And again, all of it has to be very thoughtful and conservative because these folks are on this is affordable housing. So our model is that we buy value add communities, we rehab existing homes, and we purchase new homes. And this is just an example of a few before and afters. I mean, you'd be amazed at some of the condition. And so on the left-hand side, you just have, it might cost us for a heavy-duty renovation, it might cost us $10,000 or $15,000 to renovate that home. And again, that might sell for $20,000. And it's not really the arbitrage of what we're spending on rehab and what we're selling it for. It's now creating recurring revenue through lot rent with a new resident who ideally is going to own that home. They're going to treat it well. It's a pride of ownership. They're going to stay longer as an owner versus a renter. Or on the right-hand side, as a new purchase, we have open lots where we have to get those lots prepped and bring in a new home. And again, that's recurring revenue for us. That's our core business. Although we've had some lending investments in the past, we generally don't want to be in that business. And so our core business is we own the land, own the lots, and our residents pay us a lot rent every month. And that's really our core business. And this is just an example of some of the renovations that we do. If you have enough homes and you have a big enough rehab and construction crew, then you're buying things in bulk and you can get your costs down. And at the end of the day, these are really, really nice homes and they're clean and safe. And that at the end of the day, that's really what people are looking for, is a clean, safe place to live. So I'll give a real example here, and this is a community that we're actually selling right now. We haven't sold anything in about 6 years because we've really been in acquisition stage. But this is a community outside of Knoxville, Tennessee. It's 123 spaces. We bought it at about 72% occupied, so that means 34 empty lots. And just the red here just is an example of what that looks like. So you've got the 123 lots, and then you've got these that are non-performing lots. There's no residents that are paying or no residents there. The NOI was with just over $167,000, and we purchased this for $1.6 million, and I believe it was about a 9.5 cap rate. And this is about 4 years ago that we bought this. So the first thing is we started to bring in new residents, and so we got this up to about 85% occupied. And there were only 18 empty lots, and now our NOI increased to $245,000, and now we're at 85 occupancy. As we went under contract on this, we were at 90% occupied, so about 11 total empty lots, so 11 units that are not generating any income, and an NOI of just under $275,000. So kind of the recap is we started at 72% occupied, we got it up to 90%. The NOI went from 167 up to almost 275,000. Lot rent here was $200. We got it to about 225 towards the end. There's still some room to grow there, but again, we had to do it very conservatively. Under contract for about $4.1 million. It'll end up selling for about a 6.6 cap, which that's about the going rate right now. We've seen cap rates trade for 3.5, 4, all the way up to 6s and 7s. So we've seen cap rate compression, just like multifamily and single family over the years. We're probably just the last asset class that's gotten hit really hard with that. So I just thought this was interesting. This is a real example of what we have under right now and exactly what we did to improve NOI. And that's really it. And happy to answer any questions, talk about the company or the team or anything like that, or anything in affordable housing.
Yeah, thanks, Andrew. That's awesome, and a great example over there as well. If you guys have any questions, feel free to speak up or just put your questions on the chat, and I will relate.
So this is Janice Laramie. I'm thank you for the presentation. It was really interesting. So one of the things I've been thinking on my side in terms of my investment. So I was just curious, based on your experience, because you mentioned this is a really, really cheap homes, right? Cheap to build, cheap to maintain. So as far as you renovated some of these not renting units, so like, what was your rationale? Because ideally, because these are such a cheap land. So I live in New Jersey, so all of this looked really cheap to me. So you kind of like get rid of all the really old, dingy homes, outdated, just build a brand new ones. So what was your rationale just renovating and doing that? So like, what are some calculations gone beyond that?
It's so simple. If you have a $20,000 home versus a $40,000 home and you make $26,000 a year, that's a big difference. It's that simple. These aren't stick-built homes, right? These are sitting on pads. They're manufactured homes. So we could go in and there could be a home that's 30 years old and the frame is in good shape, but it needs to be gutted. It needs subfloors. It needs appliances. So we can go in. We call that kind of the low-hanging fruit, because we can turn around and put 10 or 15,000 into it, and it looks really nice, and it's got another 15 or 20 years in it. But the biggest thing is that the resident now can buy that home for $20,000 versus $40,000, and the difference in payments. This is almost like used cars, where the sticker price isn't as important as the monthly payment. That's all about the monthly payment. Yep. So if you make $28,000 a year and you take home $540 a month, like that doesn't leave you very much for again, you can't afford an $1,100 apartment. I mean, it's really tight. So you've got to look at affordable housing. So that's really the reason. That's a great question, though.
Okay, great, thank you.
Okay, so we have a question on the chat from Alexei. So he's asking what kind of flooring materials you're using for renovations.
Yeah, generally, I think everything's been laminate. I couldn't tell you what the SKU is, but I think a lot of the stuff we were buying was from Lowe's. It was Lowe's or Home Depot. I think most of it was Lowe's, and so we'd buy stuff in bulk. But a lot of it was laminate flooring. It's definitely not wood floors, but it's laminate. We use the same SKUs and the same sort of cabinetry and sinks and things like that to make everything look nice and kind of uniform.
I have a question. Andrew, Victor here. How do you finance some of these trailer parks?
So this is the biggest difference between multifamily and manufactured homes and mobile home parks is that there's several layers of debt. And the first is on the land. So you buy this mobile home park, and let's say it's $5 million, and you're going to find a bank, and Fannie and Freddie are in the space. We've done CMBS loans. There's everything from, let's just say, 3% all the way up to hard money at 10 or 12%. There's that whole range of loans, and that's on the land itself. That's the business, right? You have lot rents, you have income, you have expenses, you have NOI, and that's what the lenders will lend on. Then you have the home lending, which is a different kind of loan. It's what's called a chattel loan, which is the same thing if you were to it's the same titling as a car or a boat, and that's why it's so specific. And Fannie and Freddie are not in that space, but Berkshire Hathaway has a lending company. And so the residents will put an application in, they get approved. I think Berkshire said that out of their 21st mortgage has, I think 8 or 9 billion out in loans. Their median FICO is in the mid fives. So they're looking at job history. They haven't had a bankruptcy in X amount of years, but again, these folks can't get a Fannie Freddie single family loan. And so that's the second layer of this, is that the residents get financed for that home. And generally the operator, the owner, the sponsor is on the hook for that. So here's a scenario. John Smith comes in, they get approved. They buy a $25,000 home. They're making payments. 9 months later, he loses a job. He can't recover from it. You can't work out a deal. And you have to evict John Smith. Well, we're in very landlord-friendly states. We're not in California or Oregon or these other areas. So we can evict someone fairly quickly. And once we evict that person, we go and we fix up the home. In most cases, it's just paint and carpets and kind of dust it off, because remember, they're the owner of that home. So they're less likely to trash it. And then we go remarket that home. And in some cases, we actually make money on that process. Our model is not to go and sell homes and evict people and flip homes. That's a horrible model. But if that does happen, then we can, if someone does trash the home, then we can elect to take out the insurance policy and rehab that home again. But generally, it's pretty light repairs. So Fannie, Freddie, and all the big lenders are in on the land side, and then specific groups and lenders are in to finance the residents coming in.
I see. Thank you.
Did that answer your question, Victor?
Yes, thank you.
Okay, great.
What about the equity, Andrew? So do you structure your project as a syndication, or do you have like a private equity structure?
Yeah, it's mostly been on the syndication side. My partner and I have done some deals together, and it's generally on the LP side. So we have limited partners to come in when we have a project, and we'll structure it. It's pretty common to multifamily. There's a preferred return, there's a split, there's a hold time, depending on if we're buying something that's more value add, lower occupancy, or is it more stabilized, depending on the structure of the deal. And there's a specific hold time. So similar to like a multifamily syndication.
Yep, makes sense. And what about, actually another question, so you mentioned on the financing side, like Fannie, Freddie, and some other players on the land side specifically, but do they require higher down payments on those compared to multifamily, or how do they approach this?
No, very, very similar. Yeah, they've been in this space for a while.
So like
you're going to get
25%.
Yeah, I think in general,
well,
we're probably across the portfolio, we're probably at 50% LTV, maybe mid 50s when you lump all of the resident debt together. But you can find loans that are at 75% LTV. We did some CMBS loans in 2019, which are, back then it was like, I don't know, 4%, which was really good for 2019, and it was maybe a 65% LTV. And the CMBS loans are very, very expensive because of the legal to get it papered, but the rates were good. So yeah, there's probably the same kind of lenders there are in our space than in multifamily.
Your equity, like at entry, usually is closer to 50% actually.
Say that again.
Is that right? your equity that you raise, like from limited partners, etc., it's upon entering a deal is usually closer to 50%.
It just all depends. I mean, that's about our LTV now across the
Okay.
portfolio. Yeah.
Got it.
Yeah.
Okay. Do you guys have other questions?
Yeah, who are the heavy hitters? The most the ones that do most of the lending on parks. Is there a
Well, B Fannie Freddie probably has the most volumes, and then there's regional. I mean, there's thousands of lenders out there that lend specifically on this, so you can either go the broker route or go with someone specific. But there's tons of lenders. I would guess that Fannie and Freddie probably have the most volume in the space. That would be my guess.
If you can come back to your the last your deal scenario that you had that you're currently selling, since I think it's a absolutely outstanding actually.
Sure.
So at the previous slide, like at the entry, is that at the entry point, the previous slide, so you had 9.5 cap actually upon purchasing the deal. So was that, I mean, that's pretty high on its own, right? In a way, like separately from that cap rates later compressed, etc. Is that typical in mobile home parks? What is your target range upon entry?
Well,
Besides,
so 5 or 6 years ago, we were buying anywhere from 8 to 15 caps.
Yeah.
So that's what the market was. That's what the environment was that many years ago.
Caps.
Yeah,
with like below the conservative renovation vacancy, repair vacancy, etc.
Yep. And now, I mean, there was a portfolio that sold here. I think it was in Phoenix. It sold at a 3.5 cap, and that was Q4 of last year. So, I mean, a year and a half ago, Marcus and Millichap put out a package that had a 4 cap in Alabama and a secondary market. I mean, this is where it's all been headed. But remember, we haven't had a real estate crash in 12 years, right? We're so far past the subprime crash. So real estate's at an all-time high. Commercial real estate's at an all-time high. Inventory's low. The market's at an all-time high. Interest rates are at all-time low. I mean, it's pretty wild, all of these things, and there's so much money on the sidelines. And like a company like Blackstone coming in and deploying 550 million, that probably opened up the floodgates even more. So we expect to see cap rates continuing to compress in our world, and
so
who knows what's going to happen.
What's a good target to have? Let's say if I wanted to enter the space, what would be a good cap rate for that?
If you personally or for your investors, I mean, whoever's writing the check, it's really question. Up to them, right?
Not me personally. If like it's sort of a favorable range, like would it be like, is 8 out great now? Or, I guess
8 caps are hard to find.
Yeah, hard to find.
Yeah.
Makes sense. Well, it sounds like
more buyers in this space than ever before, whether it's a first-time buyer or a multifamily buyer who can't find deals anymore because that space is so, so I feel overpriced. I have friends with 10, 12,000 units in that space, and they're not buying. They're just managing, or maybe they're selling.
I mean, sounds like that's maybe the flip side a bit of the chart that you showed actually, where MHP, price performance has been way outstanding, right, compared to anything else. So that gets reflected in the caps probably even further in that sense.
Sure. Yep.
So Andrew, I have a question. So when you purchase this mobile home community, you have a site map with office. So did it have an infrastructure? So I'm not very familiar with mobile home. I never lived in it. Like, I have no idea. So was it something like infrastructure came where the property management office was in there before, and then you've just purchased this land and ownership of it, and so they already had infrastructure running the residents, they're familiar with the community? Because like I live in New Jersey and I have no idea what it's like living in mobile home in Tennessee, right? Yeah.
Yeah.
So what was it? Yeah, what happened?
Most of them were built in the 60s and the 70s and some in the 50s. And that's when the majority of the data is very poor out there, but there's somewhere in the vicinity of about 40 or 50,000 mobile home parks in the United States. And then there's some that are getting torn down, a handful that get built. So some of them have offices on site. Some of them have actual trailers that were turned into an office. Some have 4 lots. Some have 370 lots. Some are on a half an acre. Some are on 500 acres. I mean, it's that kind of a range. And sometimes you go in. I mean, in everything we own, they rate these from 1 to 5 stars. 5 stars is $1 million home in Malibu overlooking PCH, where you own a little tiny piece of dirt, and a 1 star is probably a secondary or tertiary market that's that's completely in distress, where the town's in distress and the park is in distress. Like, we're generally buying stuff in 3-star parks, because that's kind of our sweet spot where the cash flow works. So we don't have pools, we don't have clubhouses. You think about what you get for $300 a month in lot rent and another $300 to own a home. You wouldn't expect there to be fancy amenities. So it's generally an office. Maybe it's a little, playground for the kids, or some swings and things like that. Everyone's a little bit different. They're definitely not cookie cutters, but you always have a manager and a maintenance person on site if you have 100 units. Does that help answer that?
Yes, just gotta get a sense of that. So the other thing is like in-unit laundry, right? So I've always felt that the tenants stay longer if there's in-unit laundry, no matter how fancy or just mediocre the place is, right? So like mobile homes, based on your experience, does it make a difference whether because I see laundry on the separate, right, on site, so they have to walk outside. Yeah, does it matter?
Yeah, and we don't install washer and dryers in the units. It's just not.
Okay.
This isn't the demographic for them.
Okay, so no.
And there may not be a laundry,
yeah.
and there isn't a laundry facility on site at most of them. That this is probably the minority, actually.
Okay.
Yeah.
Well, question. What about appraising? How do you appraise a trailer park? You use
Same thing. Commercial appraiser. Yep, commercial appraiser, just same thing. And so it's not like residential. It's just like a commercial loan. They're looking at everything, but they're looking at your income and your expenses and your NOI, and they'll get a commercial appraisal, and the comps factor in. But it's all boils down to your NOI. That's the biggest way that on the appraisal side. So just normal commercial appraisers and lots in the space.
Thank you.
And Gabriel, I have a few questions. Thanks for the information so far. What's the typical delinquency rate and turnover rate for these?
Delinquency, I mean, we as far as occupancy goes, when we consider stabilized in the low to mid 90s. It just depends on if someone's renting. There may be a higher turnover than if someone owns their home. That's generally the case. I think if the defaults can be anywhere from about 5 to 10% on loans, something like that. So you factor that into your pro forma. So it's unique because it's, if these folks don't own a home in a community, they're going to be renting an apartment. So you have to look at it from a couple different angles, but generally 5 to 10% defaults when someone owns a home. And then we have communities in areas where there might be a military base, and so there's a higher turnover there and less people who want to own because they know they're going to have to move in 2 years. So some of it's regional as well.
And does the city give you any pushback, or the county, would they give you any pushback when you're filling in or reactivating the vacant lots?
None. It's usually the opposite. I mean, especially if you go in and you make good improvements. Imagine a community being built in 1970, and at some point in the 80s and 90s, it was at 100%, and someone took over, and it was a slow decline down at 48% occupancy over 15 years, and there started to be folks moving in selling drugs, and it just became kind of an eyesore in the community. You go in and you spend $100,000 on tree trimming, and you're fixing the roads, and you're knocking out the demos, the homes that can't be fixed, and you're bringing in new homes, and you're putting new signage up and all these things. I mean, not only are the residents thrilled, but the city is generally pretty thrilled because you're taking kind of an eyesore and you're turning it around. So it's actually the opposite. You definitely, now going and developing is a whole different deal, but when you're improving an existing mobile home community, it's usually welcomed.
Are you able to capture any fees when you're selling the home? Like broker fee, developer fee? Is Berkshire, are they paying those fees to you directly?
Well, there's definitely fees if there's a sale involved, and maybe that goes to the manager, or maybe it goes to someone in sales and marketing, or it's split a couple ways. In general, if we put $15,000 into a home and we sell it for 20, there's a couple bucks there when it's all said and done after fees and commissions. But again, that's not our. Even if it costs us $1,000 when it was all said and done, but now we have $300 a month coming in recurring revenue, that's a no-brainer, right? Because we're filling up the park and we're creating recurring revenue. So they're definitely fees part of the home sale, and our goal is really to break even on those homes. And if we make some make some money, then great. But generally, it's a break even.
I have a question about the construction, if you don't mind, Andrew.
Sure.
Yes. So when you're talking about the value adds, and of course it's out of states, how the model works in terms of like bringing the materials, bringing the contractors or people who will be doing this, and who is managing this?
Yeah, we have a construction company, and so we have a team that all they do is renovate homes, and they've been trained to do that. So they'll go in and they'll travel in groups of 4 to 6 typically. They'll go into a community and they'll renovate 20 or 30 or 40 homes. They'll be on site for several months, depending on the size of the project. And they know exactly what SKUs to buy at the Lowe's or the Home Depots. They know exactly what cabinetry, what appliances, all of that if it's a full renovation. So, and otherwise, you're trying to, we tried to do this with subcontractors for the first few years, and it was, it's like try managing 10 subcontracting crews in secondary markets in 8 states. I mean, it's very, very difficult. So we decided to build our own construction company to do that.
Who is making decisions on the buying the supplies for, the construction materials?
It's the team that oversees the construction company.
Okay. Is it the chance we can talk maybe offline? I want to touch more about the construction supply part and ask some questions, because that's my second business that I'm doing. I just want to like understand better the model and if we can fit into this model.
Okay, sounds good.
I
Thank you.
have another question. So, so Andrew, oh, I'm so sorry. Was someone else speaking? Okay. So in terms of these are low income housing, right? So Andrew, did you run into any regulations or state law that had something to do with rent control or some of the regulations you've noticed?
Nope. No, we're in landlord friendly states, and this is in Section 8 housing. We have a couple residents in Ohio that get some assistance from the government, but that's it. This is in Section 8 housing.
Okay.
Yeah.
Thank you.
Sure.
Okay, and another question we have on the chat from Holly. So as the market becomes competitive, what's your strategy to find a new deal? Any other investment area in real estate you're looking at?
Yeah, it just depends on if our cap rates continue to compress, we're going to buy less. Most likely, there'll be fewer deals to look at. But we've closed on 35 deals, and we have great relationships with brokers, so we'll keep buying as long as the deals are out there. Yeah, we're looking at a couple of other things, but we still have quite a bit of work to do in this space. We feel like we got in at a pretty good time after 6 or 7 years, and my partner's been in it for over a decade. So at some point it may make sense not to buy anymore, and we just simply hold. And like everything else in real estate, it's cyclical, and there'll be a correction, and maybe it goes back to 8 caps and 9 caps again at some point. Just hard to say when or how that's going to happen right now.
Have your target markets changed with that? Like, what are some more favorable markets nowadays that you are looking at potentially?
No, not really. I mean, we've been in secondary markets for the most part. Most of it's in the Midwest. There's a couple areas that we probably wouldn't buy very much more in. And our goal is not to be in every state. It's really to be clustered as best as we can in certain areas. So, areas like we're not in Florida, it's just been overpriced, but areas like Alabama can be challenging sometimes because of the hurricanes and really the cost of insurance. When you have a hurricane go through, your insurance can double or triple in some cases. So, always be mindful of things like that.
Do you think that any of these locations have an exit opportunity where you can just redevelop the entire land? Because sometimes you're picking up huge plots of land where the neighborhood has now changed and you can actually do some fix like multifamily housing.
Sure. I mean, it really depends on what your exit is, whether it's, I mean, you could certainly be in the path of progress and someone come in and offer you a lot of money to buy the park because they're going to turn around and scrape it and build something on it. There's always that chance. And if you're in the business of land banking with an exit because you're going to build more multifamily, that could be something. Just all depends on what you're looking for. But yeah, you're right. There's a lot of acreage that you're typically buying when you buy these communities.
Are there lower tax benefits to this? Because you buy a multifamily deal, you do cost segregation, you get accelerated depreciation, you're taking that down. How does that situation play out here? Because you're getting financing for the land and then the house is separate.
It's the same. We do cost segs for most of the properties that we have. The one difference is that you're spending more of your resources on common areas than one structure in multifamily. But you could have homes you'd appreciate, you could have roads, you could have common areas, lights. There's a lot of stuff, and there's companies out there that specialize in mobile home park cost segs as well.
And the landscape on the property management side, do you feel like it's pretty straightforward for you to find a property management company that's comfortable running mobile home parks?
There's less than multifamily, considerably less, and very few, if none, national property management companies. There's some that say they are, but I mean, if you're operating in a dozen states, that's very, very, very challenging. That's why we started our own, is because we couldn't find a good property management company to cover all the areas that we were in.
And is it mainly broker relationships as far as finding a deal, or is it? Have you ever found a deal of Crexio or WhoopNet, or that's pretty much not?
Yeah, never. Yeah, it's mostly relationships. We did some direct mail that was okay. It's mostly relationships though. Most of the stuff on LoopNet, I mean, it's going to be picked through like anything else.
Over future deals, what are you looking? Like, what's your vetting process? What are you really generally looking for? What KPIs you want to hit on a new deal?
Yeah, it just depends on the areas that we're in. I mean, we're looking at really what to get a good current snapshot of where something is and what we can take it to, since we buy so much value add. We're looking for the job drivers. We don't need to be in a huge MSA, but we can't be in a one-horse town where there's a meat packing plant and that's 90% of the jobs. There has to be Walmarts and Targets and things like that. But again, our collections were at 90+% in 2020, and so our residents, they work at gas stations and Walmarts and Costco's and Targets and anywhere where folks make less than $31,000 a year. That's where our residents are for the most part. They're not an executive at IBM or work at headquarters in Amazon or Apple, the headquarters at Apple. It's just not our resident base, right? So we need enough of those job drivers to make sense. So if we go in and there's no Walmarts within 60 miles, there's no Targets, things like that, then we'll probably not look at that deal.
Are you able to get, would they issue Section 8 vouchers on this housing or not?
I don't think so. We have 0 Section 8 residents. I believe it's only on apartment buildings, but I'm not 100%, but it doesn't apply to us.
Okay, great. Maybe last question, one or two, if you guys have. before we wrap up?
Do you know what your IRR is going to be on this deal? The one that you presented?
Yeah, generally, it depends. I mean, they'll range from about 16 to kind of 20, 20, 22, maybe 23%. It just all depends. I mean, interest rates are starting to rise. That's one of the biggest drivers of IRR is interest rates. Obviously, hold time factors into that. So, I mean, we'll look at equity multiple, cash on cash. So it just depends. If you're buying something more stabilized, I mean, the big question is what are refinances going to look like in 3 or 4 years? Are we going to go back to 4%, 5%, 6%? They're starting to creep up again. The Fed said that rates are going to be low for another year or two, but are they going to hit 8% and everything falls apart? I mean, it's so hard to tell, right? They've certainly been the lowest they've ever been in my lifetime.
Yeah, absolutely. I just closed yesterday, and I'm over 4% on a Fannie loan. And
Yeah,
when I started the process, we were like at 3.8ish. I'm like,
Yeah.
oh man, it's killing me.
yeah, they're sneaking up. That's for sure.
Okay, guys, last question. Anyone?
All right. What markets are you in again, Andrew?
We're in 12 states, most of that Midwest area down to the Southeast. Most of them secondary markets. So we have 35 communities. I mean, we're probably in 30 markets. So mostly Midwest into the Southeast.
Okay, thank you so much. Thanks a lot, Andrew. That was great. That was
Great.
very
Thanks
useful information.
thanks for having me. Appreciate it. And thanks everyone for showing up. Appreciate you.
Thank you, Andrew.
Yeah, thank you
you.
guys. And just one thing to mention before you guys take off. So this recording is going to be on YouTube. So Finance Meets Real Estate on YouTube for a recording of this video or others if you want to review your materials or anything. So yeah, so please subscribe to our channel there as well. I'm going to put it on the chat here as well.
Stefan, are our questions also recorded online?
No, the chat questions, no, actually, no.
Okay, perfect.
Unfortunately, yeah.
Perfect.
Okay.
All right, thank you.
Okay. Thanks everyone.
Thank
Thanks
you.
everyone. Yeah,
Thank
thanks
you.
Anderson.
Thank
Thanks
you.
so much.
Thank you so
Okay.
much.
Take care.
Thanks everyone for joining.